In 2010, Amazon lost around $100 million in 3 months to win a fight over diapers. That's true. We spent 15 minutes proving it. Here's what we left out. The man who lost that fight walked away with $545 million, and 6 years later sold his next company for $3.3 billion. Same facts. Completely different story, depending on which ones you're allowed to hear. So this is the other half of the trial. The case for Amazon. And it rests on the most uncomfortable idea in business, that everything we just called a crime might be exactly what winning honestly looks like. If you're new, this is the third and last part of a series. First, we followed the money and showed how Amazon actually makes it. The store is bait, the profit hides in the cloud, the ads, and the seller fees. Then we prosecuted it. One charge: predatory pricing, selling below cost, not to win you over, but to make competing financially impossible. We argued it as hard as we could. Today, the defense stands up. Same courtroom, same charge, same evidence. Because the defense isn't going to deny a single fact from that video. It's going to accept all of them, and then argue that they add up to something else entirely. Court's in session. The prosecution's case rests on one assumption. It's never stated out loud, but everything hangs on it. That a company losing money on purpose must be buying the market. The defense says it was buying something else. Capacity, warehouses, trucks, servers, software, not a weapon, a construction project, paid for in advance by a company willing to look stupid for 20 years. And here's the good news for both sides. This isn't a matter of opinion. There is a test, one question that separates a company buying the future from a company buying the market. And courts have been asking it for 30 years. We'll get to it. First, 5 pieces of evidence. Same facts you already heard, read the other way. Exhibit A, the prosecution's star victim, Quidsi, the company behind diapers.com, destroyed by a price war it couldn't afford. Start with the part that got skipped. Quidsi wasn't a corner store. It was a venture-backed startup, funded by investors, spending their money to grow. And it was selling below cost too. Think about what it was actually doing. Free 2-day shipping. On diapers. The heaviest, bulkiest, lowest margin object in retail. Nobody makes money doing that. Nobody was supposed to. It was a land grab, financed by somebody else's cash. So we have 2 companies pricing under cost, both funded by patient investors, both betting the winner takes the category. Only one of them is on trial. And it's the one that was better at it. Now the ending. Quidsi's founder, Mark Lohr, sold to Amazon for $545 million. He didn't retire. He built another company, Jet.com, and in 2016 sold it to Walmart for $3.3 billion. Then Walmart handed him the keys to its entire U.S. online business, a job he held for the next 4 years. The man Amazon supposedly destroyed spent them running Amazon's biggest competitor. Hold that thought. We'll need him again. And the prize? In 2017, Amazon shut diapers.com down, permanently. Because after 7 years of ownership, it still didn't make money. Sit with that because it breaks the story. If you kill a rival to seize a valuable market, you keep the market. Amazon wrote its off. Whatever that $100 million bought, it wasn't a prize worth having. The honest strategic read is colder and less dramatic. Quidsi's only real edge was that somebody else was paying its shipping bill. Amazon didn't need to out-innovate that. It just needed to still be standing when the money ran out. When a rival's only advantage is somebody else's subsidy, you don't have to beat them. You just have to still be there when the subsidy stops. Exhibit B. The prosecution showed you 2 lines. Profit flat at 0 for 2 decades, market value climbing anyway. It called the gap a war chest, money stockpiled to outlast anyone. Let's kill that idea first, because it's wrong. And it's wrong in a way that matters. A rising share price is not money in the company's bank account. It's investors trading shares with each other at higher and higher prices. Almost none of it ever reaches the business. So if the market value wasn't the war chest, what actually paid for 20 years of building? 2 things, and neither one is glamorous. First, Amazon's profit was near 0. Its cash never was. When you spend billions on warehouses, The accounting rules make you subtract a slice of that cost from your profit every year for a decade, a charge on paper, not money leaving the building. Thin profit, full bank account. Second, and this is the real machine, you pay Amazon the instant you click buy. Amazon pays its suppliers 60 to 90 days later. It has spent 2 decades running about 7 weeks ahead of its own bills. Every sale doesn't consume cash. It creates it. That's the war chest. Not the stock price, the float. Other people's money held for 7 weeks at the scale of a country. The share price did matter, just not as cash. It bought patience, shareholders who never demanded a dividend, cheap borrowing, and a currency valuable enough to pay engineers with. And that cash never sat still. It went out every year, immediately, into the most expensive physical build-out in modern commerce. Fulfillment centers. A delivery network that in 2025 carried more parcels than UPS, more than FedEx, more than the US Postal Service, and a wall of servers that accidentally became AWS, Amazon Web Services. Its cloud division, capital expenditure, money spent on physical things you keep. In 2025 alone, Amazon spent more than $130 billion of it, up almost 60% in a single year. Now, they spent a lot isn't a defense. Anyone can burn money. The question is whether it came back, so here's the number that actually settles Exhibit B. You already know the answer. You just haven't been told to call it that. All those servers Amazon overbuilt for its own store became a product it could rent to everyone else. In 2025, that business, AWS, earned $45.6 billion in operating profit. Think about the size of that. It's more than half of everything Amazon earns, thrown off by the leftovers of the construction project the prosecution called a weapon. The spare capacity became the profit engine. And if you want proof it built infrastructure rather than a weapon, look at who runs on it. Netflix, the direct competitor of Amazon's own Prime Video, runs on Amazon's cloud. You don't rent your fortress to the army you're fighting. Every generation calls this reckless. Railroads that bankrupted their builders and then carried the country. Fiber laid in the 90s by companies that went bust and then carried the internet. The bill always looks insane right up until it becomes the road everybody drives on. And here's the part that should make the defense nervous, except it doesn't. Amazon is doing it again, right now. In 2025, it generated $140 billion in cash and spent $132 of it building. What was left over fell by more than 3/4 in a single year. On the last 12 months, it has gone negative. It has committed around $200 billion to artificial intelligence infrastructure, which means the construction bill isn't a story about the past we're telling to excuse Amazon. It's the literal state of its balance sheet today. Same bet, same discomfort. 30 years later. A loss that leaves an asset behind isn't a loss. It's a payment plan. Read the cash flow statement, not the earnings line. Exhibit C. This is the test I promised you, and it's the heart of the whole case. In America, to convict a company of pricing predatorily, a court demands 2 proofs. 1, that it sold below its own cost. 2, and this is the one that matters, that it then raised prices back up to make the money back. That second requirement came from a 1993 Supreme Court case, a brawl between 2 cigarette makers over discount packs. The court's reasoning was blunt. Cutting prices to win customers is the point of competition. Punish it too easily, and you punish the thing you're trying to protect. So the court asked the only question that separates a price war from a heist. Not did prices go down. Anyone can do that. Did they come back up? Because if they never do, the customer was never robbed. Somebody just did the job cheaper. The prosecution called that a loophole. Here's why it's a safeguard. And this is a true story. A&P was the biggest grocery chain in America. Its trick was simple. Buy directly from producers. Skip the middlemen. Pass the savings on. Groceries got cheaper. Customers loved it. Competitors did not. In 1946, the United States government took A&P to court and won. The most efficient grocer in the country was convicted in effect for selling too cheaply. Nobody today remembers that as justice. They remember it as the moment the law protected competitors instead of customers. That's the mistake the 2-part test exists to prevent. And it's why the Supreme Court has said, plainly, that cutting prices to grow the business is the very essence of competition. So, did Amazon's prices come back up? 30 years in, with the field supposedly cleared, online prices have gone the other way. While the cost of nearly everything else in American life rose, whole online categories, clothes, toys, electronics, have been getting cheaper year after year. The defense should be honest about the one exception. Regulators allege Amazon ran a secret pricing system between 2015 and 2019 that raised prices when it expected rivals to follow, which is literally the second proof. Amazon denies it, says the tool existed to stop unsustainable price-matching spirals, and shut it down in 2019. No court has ruled. It is an allegation, and it is the single best card the prosecution holds. But an allegation about one algorithm doesn't move the line on your receipt. And the receipt is what the test asks about. The line between investment and predation isn't the price you charge going in. It's the price you charge once you've won. Exhibit D, the prosecution's fallback. Fine, Amazon never raised your prices. Just moved the bill onto the sellers. Close to half of a sale gone in fees. Start wide. More than a third of every dollar Americans spend online is spent on Amazon. If you make something, that isn't a shelf. That's the entire street. And it's not just traffic, it's intent. Shoppers on Amazon buy roughly 7 times more often than shoppers on a typical online store. Most websites are a browsing experience. Amazon is a checkout with a search bar attached. So what a seller is buying isn't shelf space. It's a customer who has already decided to buy. That is the most expensive thing in commerce, and it's the one thing nobody puts in the spreadsheet when they complain about fees. Now price the alternatives honestly. Sell through a traditional retailer and you sell at wholesale, roughly half the shelf price. You lose control of your own pricing. You lose the customer entirely, and you often eat the returns anyway. Build your own store instead, and the fee looks like zero. Right up until you pay for the warehouse, the staff, the payment processing, the returns, the customer service, and then the line nobody ever budgets, buying the traffic, advertising to strangers until some of them show up. Which brings the actual evidence. Not a fee schedule, but behavior. Nobody is forced onto that marketplace. The terms are public, and third-party sellers now account for around 60% of everything sold on Amazon, an all-time high. Millions of independent businesses looking at that fee, running the numbers against every alternative, and choosing it anyway, in record numbers. You can call that a captive market. Or you can call it a price people keep agreeing to pay. A high take rate isn't extraction if it replaces a cost you were already paying. Price the alternative before you call it a tax. Exhibit E, the whole case, every count, depends on one quiet decision nobody argues about, where you draw the box. Draw it around online shopping, and Amazon looks enormous. Draw it around shopping, where people actually buy things, where clicking and driving to a store are the same decision, and Amazon is about 10% of American retail. Still behind Walmart. 10%. Roughly 9 out of every $10 Americans spend on things get spent somewhere that isn't Amazon. And then the fact the prosecution can't explain. Amazon's share of American online spending peaked in 2021 and has been falling ever since. Start with Walmart and be precise, because the two halves of that company behave differently. As a physical retailer, Walmart is still number one. Roughly 4 out of every 5 of its dollars come from actual stores. Online, it was the underdog. Not anymore. Walmart's online business now runs at around $150 billion a year, growing over 20%. 5 straight quarters of it. While Amazon's share slides. The giant of the physical world is attacking through the screen and gaining. Now watch why. Because this is the market correcting itself in real time. Amazon's fees got high enough to become an opening. Walmart walked straight into it. Lower fees, easier onboarding, fulfillment that now rivals Amazon's own. Sellers noticed. Walmart's marketplace passed 200,000 sellers for the first time, adding 44,000 in the first 5 months of 2025 alone, the fastest growth in its history. Ask those sellers why, and the answer comes back the same. Amazon got expensive. That is the textbook working exactly as written. High margins attract entry. Entry forces prices down, which means the pressure on Amazon's fees isn't going to come from a courtroom. It's already coming from a competitor. And remember who Walmart hired to build that business. He's not alone. Shopify's merchants together are now roughly a seventh of American online spending. Temu and Shein appeared from nothing. TikTok turned a video app into a shopping mall. For contrast, at its peak, Standard Oil controlled about 90% of American refining. That is what a cleared field looks like. Monopolists don't get attacked from 4 directions at once, and they certainly don't lose share while it's happening. Before you accept a market share number, ask who drew the box. The boundary is the whole argument. Which leaves one question the prosecution never asks. Not whether Amazon is dominant today, but whether today is the right unit of measurement. Because America has done this before. There was already a company that sold everything, shipped it anywhere, and made the local store look obsolete. It was called Sears, and its weapon was a catalog. At its peak, Sears was the largest retailer in the country. 3,000 stores, 350,000 employees, and a tower in Chicago tall enough to say we won. Then a discount chain from Arkansas passed it in 1990. 3 years later, the catalog, the thing that built the whole empire, was discontinued. And the company that killed the catalog is the same one now clawing market share back from the website that hollowed it out. So look at where Amazon actually is. Roughly 30 years into consolidating a market it invented, share sliding, challengers on 4 fronts, and betting $200 billion that the next thing is artificial intelligence. Exactly the kind of bet that looked insane in 1997 and might look insane again. That's not the profile of a monopoly. That's the profile of a company in the late innings of one cycle, spending everything to survive the next one. The moat is never the market share. It's how fast you can rebuild the machine when the ground moves. So here's the defense's closing, and it's the same machine the prosecution drew. Running forward instead of backward. Capital buys capacity. Capacity lowers the cost to serve. Lower cost lowers the price. The price brings volume. Volume brings back capital. Same parts, same order. One difference, whether you read the loss as a weapon or as a bill. And here's the part neither side enjoys. When competition works perfectly, when one company genuinely serves people better, for longer, at lower cost, it looks identical to predation. Both end with one company standing and everybody else gone. There's no version of the best operator wins that leaves the losers in business. That's not a flaw in the story. That's the story. So the discomfort we feel looking at Amazon may not be evidence of a crime. It may just be what winning looks like when it's earned. One question before you decide. If we write the rule that stops this, we don't only stop Amazon. We stop the next company that spends 20 years losing money to ship faster and charge less. Because on day one, it looks exactly like this one. Nobody can tell them apart until the end. So the question isn't whether Amazon is innocent. It's whether you're willing to be wrong about the next one. And once you've seen this shape, you'll start seeing it everywhere. Other giants, other industries. The same argument, the same evidence, the same 2 ways to read it. Tell me where else you're seeing it. Now, the honest part. If this video felt one-sided, that was deliberate. So was the last one. We argue each side as hard as it deserves, because that's the only way you get to test what you actually believe. What we're not going to do is hand you the verdict. Our job is to build both cases well enough that you have to do the work yourself, and then get out of the way. You're the jury. You always were. 3 videos, 1 company, how the machine works, why it might be a crime, and why it might just be competition. That's the whole trial. Verdict's yours. Put it in the comments. Guilty or just good? And that's the end of Amazon. So tell us who's next. Which company should we put on trial? The one you think everybody's wrong about?